In the spring of 2018, a publicly traded retail company prepared its quarterly earnings report. The finance team pulled the numbers from the data warehouse. The engineering team pulled the numbers from the operational database. The two sets of numbers went to the same executive meeting. They disagreed by $4.7 million. Both teams had queried a column called revenue. Both teams had written correct SQL. Both queries had run without errors. The column existed in both systems. It was called the same thing in both systems. It meant something different in each one. The finance team's revenue was gross revenue, the total value of every order placed, before refunds, before discounts, before returns. The engineering team's revenue was net revenue, the amount actually received after refunds had been processed and discounts applied. Neither team had documented which definition their column used. Neither team had told the other team which definition they were querying. Both teams had assumed reasonably that a column called revenue meant the same thing everywhere in the company. The discrepancy was caught before the report was filed. Barely. An analyst in the room noticed that the two numbers, while different, were in the right ballpark relative to the company's known refund rate. She asked the question that should have been asked much earlier. Which revenue are we talking about? 3 days of investigation followed. Every query that had ever touched either revenue column was audited. Reports going back 18 months had to be rechecked. Some had been presented to the board using one definition. Some had been presented using the other. Nobody had known they were switching between them. The column name was identical. The meaning was not, and the gap between those two things had been silently distorting the company's understanding of its own performance for a year and a half. This is not an unusual story. It is, in various forms, one of the most common causes of reporting failures in organizations that have grown faster than their data governance. And the reason it keeps happening has nothing to do with incompetent engineers or careless analysts. It happens because naming is hard, because businesses are complex, and because the same word can carry genuinely different meanings, depending on who is using it and why. Let's understand why revenue is such a dangerous word to put in a column name. In a simple business, revenue seems unambiguous. Someone buys something. You receive money. That's revenue. But businesses are not simple. Does revenue include tax collected on behalf of the government? Some teams say yes. Some say no. Does it include shipping fees? Depends on the business model. Does it include gift card redemptions? Only sometimes. Does it include revenue from subsidiaries? At the group level, yes. At the entity level, no. Does it include recognized revenue under accounting standards or cash received, which can be different if payment terms allow invoicing on net 30? Does it include revenue from cancelled orders that haven't been refunded yet? Does it include revenue in foreign currencies converted at today's rate, or the rate at the time of the transaction? Every one of these questions has a legitimate answer that varies depending on the team, the purpose, the accounting standard, and the reporting period. Every variation produces a different number, and every variation can be stored in a column called revenue. The column name tells you nothing about which version you have. Now multiply this across an entire organization. The sales team tracks revenue as the value of closed deals. The finance team tracks revenue as cash received. The product team tracks revenue as the value of completed orders. The data warehouse team tracks revenue as the output of a transformation pipeline that applies a set of business rules written 3 years ago by a data engineer who is no longer at the company. Each definition is internally consistent. Each serves a legitimate purpose for its team. None of them agree with each other. And when any two of them end up in the same dashboard, the same report, or the same executive presentation, the result is a number that looks authoritative and means something nobody in the room can fully specify. This problem has a name. In data engineering, it's called the lack of a single source of truth. More precisely, it's a metric definition problem, the same metric name carrying multiple incompatible definitions across different systems, teams, and time periods. And revenue is just the most visible example. The same problem lives in columns called users, is that registered users, active users, paying users, or monthly active users. In columns called orders, placed orders, confirmed orders, shipped orders, or delivered orders, every metric that sounds like a single fact is actually a calculation with assumptions buried inside it. The column stores the result. The assumptions are invisible. Let's look at what this costs in practice. A growth stage technology company was tracking its monthly active users as a key metric for an upcoming fundraising round. The metric lived in a dashboard that investors would review. Two definitions of active existed in the codebase. The product team defined active as logged in at least once in the last 30 days. The data pipeline defined active as performed at least one core action in the last 30 days. Core actions were defined in a config file as a list of event types. The config file had last been updated 14 months ago. Several new features had been added since then. Users of those new features were not counted as active because the events they generated weren't in the config file. The dashboard showed the data pipeline's number. The product team quoted the product team's number in meetings. The difference was 23%. An investor asked, during due diligence, for the methodology behind the MAU figure. The answer required 3 days of investigation before anyone could produce a complete, accurate description of how the number was calculated. The number itself was not wrong. It was precisely calculated according to a specific definition. The definition had just never been written down anywhere a non-engineer could find it. 23% is not a rounding error. It is the difference between two honest answers to the same question that nobody had noticed were different questions. So what does good look like? The first step is to define metrics formally, not just name them. A column called revenue should never exist without an accompanying definition that specifies gross or net, which currency, which exchange rate methodology, whether refunds are included, and at what point in the refund lifecycle, whether tax is included, whether intercompany transactions are excluded, and which accounting standard governs recognition. This definition does not live in a wiki page 3 clicks away from the table. It lives in the table itself, as a comment on the column, as metadata in the data catalog, as a required field in whatever system manages your data schemas. The definition travels with the data. Every person who queries the column sees what it means before they write a single line of SQL. The second step is to make implicit assumptions explicit in column names. Revenue becomes revenue gross, GBP ex tax. Users becomes users monthly active logged in. Orders becomes orders placed Inc. pending. These names are longer. They are also impossible to misread. The name carries the definition. A developer querying revenue gross GBP ex tax knows immediately that they are not looking at net revenue, not looking at USD, and not looking at tax-inclusive figures. They don't need to read documentation. The column tells them. The third step is to establish a single source of truth for every key metric, and to enforce that every team, every dashboard, and every report uses that source and no other. If monthly active users is defined one way in the data warehouse, that definition governs every place that number appears. The product team does not maintain a separate definition. The sales team does not calculate it differently for their slides. One definition, one calculation, one number. Disagreements about the right definition are healthy and should happen, but they should happen before the number appears in a report, not as a result of two numbers in the same report disagreeing. The fourth step is to treat metric changes as breaking changes. If the definition of revenue changes, if you shift from gross to net, if you change the currency conversion methodology, if you add a new category to what counts as a core action, every historical report, every dashboard, and every downstream system that uses that metric is now showing a different number than it showed yesterday. That is not a routine update. That is a change with consequences that need to be communicated, documented, and applied consistently. A metric redefinition without communication is indistinguishable from a data error to anyone who notices the numbers have shifted. The deeper issue underneath all of this is that data has two layers of correctness. The first layer is technical correctness. The value is stored accurately. The column has the right type. No nulls where there shouldn't be. No truncation. No overflow. The database has kept its structural promises. The second layer is semantic correctness. The value means what people believe it means. Everyone querying the column is working from the same definition. The name reflects the content. The content reflects the business concept. The business concept is agreed upon and documented. Technical correctness is table stakes. Semantic correctness is what makes the data usable. And the tragedy of metric definition failures is that they are always technically correct. The numbers are stored accurately. The queries run without errors. The reports are formatted properly. Everything looks right. The $4.7 million discrepancy in the earnings report was not caused by a bug. It was caused by two accurate answers to two different questions that everyone assumed were the same question. The column was called revenue in both systems. It was correct in both systems. It meant something different in each one. And in the gap between those two meanings, an organization had been navigating with a map it believed was accurate that was drawing two different territories and calling them by the same name.